Good afternoon. My name is Mike Camara with Bogart Wealth. Thank you for attending our seminar here. We'll get started here in about a minute. And this is going to be around after-tax rollovers and the Mega-Backdoor Roth. I've still got a couple people coming in. All right, we're going to get started. Again, my name is Mike Camara with Bogart Wealth. This is the after-tax rollovers and Mega-Backdoor Roth presentation. Before we get into the subject at hand, just a little bit about Bogart Wealth. We're a registered investment advisory firm. We manage about 1.8 billion of assets under advisement, working with about 900 plus households. 90% of our clients are major oil and gas. We work as fiduciaries, and what that means is we put our clients' interests first. That's always acting in good faith, being transparent on our fees, basically a lot of nice stuff. Two sides to the brokerage service industry, the suitability side and the fiduciary side. Suitability are going to be more your broker dealers, your insurance companies and banks. Fiduciary is a higher level of client care, again, putting our clients' interests first. This is our team. You can read anybody's background on our website. And we have a tax team here located in the Woodlands as well. 3 office locations, the Woodlands, Texas, where I'm located, downtown Houston, and McLean, Virginia, where our operations group is based out of. Our mission is to help our clients achieve financial peace of mind by preserving and maximizing intergenerational wealth. A lot of nice things that we like to cover, and we have a lot of topics in addition to this seminar that we go into as well. One of our calls to action is to have a one-on-one session with one of our advisors. That's at no cost, completely complimentary, no obligation as well. It's a way for us to get to know your financial situation and see if we can help. So here's some of the seminars that we put on around retirement readiness. First and foremost, retirement planning timeline, retirement income planning, Social Security strategies, tax planning, tax law changes, estate planning strategies, NUA, which stands for net unrealized appreciation and post-retirement strategies, long-term care planning, Roth versus traditional IRAs, and then the Mega-Backdoor Roth, which is what we're getting into today. So the agenda for today is to do an overview of different retirement plan account types, talk about Roth conversions, because sometimes there's some confusion between what is a Roth conversion and what is a Mega-Backdoor Roth, what I call rollover, reasons to convert, how the Mega-Backdoor Roth strategy works, the in-plan Roth conversion and after-tax withdrawal potential also that you have with the Exxon plan. This is going to be mainly centered around the Exxon plan. Examples on the Mega-Backdoor Roth without company match at this point. Match is obviously coming back in October. Examples of the Mega-Backdoor Roth for a full year and what that can turn into, and then in-plan Roth conversions and after-tax withdrawals to differentiate the Mega-Backdoor Roth versus the in-plan conversions. So let's talk a little bit first around qualified accounts, 401ks, IRAs, 403bs, and 457s. So there's good and then there's other parts to it. The good part is that salary contributed are done on a pre-tax basis. You save taxes every year while also saving for retirement. You pay no tax on any gains or appreciation until that money is withdrawn. No taxes on any dividends paid out as long as they remain in the plan. And you typically receive a company match, even though sometimes that gets suspended or can go away, but typically a company match is provided within a 401k plan. Now here's the other part, some of the not so good. A tax penalty of 10% is applied if money's taken out early, basically if the funds are taken out prior to the age of 59 and a half. Every dollar, both original cost and appreciation, will be taxed as ordinary income when you take that money out. And you have to promise basically to take the money out once you reach a certain age or start taking the money out. The government enforces what's called required minimum distributions that basically have to start once you reach the age of 72. It is 72 now, it used to be 70 and a half, but with the passing of the Secure Act, got bumped up to 72. If you don't take the required distribution, there's a 50% tax penalty on the money you were supposed to take out. So it can be a pretty big hit if you're not careful with that. Here's some of the limits on contributions for 2021. If you're under the age of 50, you can contribute $19,500. That's on either a pre-tax or Roth basis. If you're over the age of 50, you can contribute an additional $6,500. The plan limit is $58,000 if you're under the age of 50 for all sources. That includes company match. And if you're over the age of 50, add in this catch-up contribution, the total of $64,500 can go into the plan. So that's basically accounting for another $38,500 that can go in as either part of match, profit sharing, or after-tax contributions. The after-tax contributions are what we're going to talk about today and how to better utilize those. So a little bit about traditional IRA accounts and contributions, how those work. First and foremost, you can always put money into an IRA, irregardless of how much money you make, what you're saving in your 401k plan. Money can always go into a traditional IRA. The question is whether you're going to get a deduction or not. So if you're under the age of 50, $6,000 can go into an IRA. Over the age of 50, another $1,000 can go in for a total of $7,000. No limit on income. Again, non-deductible though. In order for it to be deductible, meaning you get a deduction on your taxes, if you're covered by a 401k plan, both as a single person or both husband and wife have 401k plans, there's phase out limits. Basically, if you're under the threshold on, let's just say joint, $105,000 of income, you're going to get a full deduction. Anywhere in between 105 to 125 in income, you'll get a partial deduction. Above 125,000, you're not going to get a deduction. If one spouse is covered by a plan and another spouse is, say, not working or works for an employer that doesn't offer a 401k plan, then those bandwidths are higher. Below 198,000, full deduction. Anywhere in between 198 and 208, partial deduction. Above 208, once again, no deduction. This just talks a little bit about the progressive nature of tax brackets. And what we're trying to emphasize here is that when you make a contribution on a pre-tax basis, that's coming off the top marginal rate. So if you're making, above 329,000, let's say, 360 or something like that, those contributions are going to come off your top marginal rate. However, when you take the withdrawals out down the road, in a lot of cases, you're going to, first of all, be in a lower tax bracket than the highest income earning years of your career. And you're actually taking it out on an average tax basis. So basically, saving on a pre-tax basis now and taking the money out later in retirement can save you on an overall tax assessment on those monies. This is a little bit now about Roth accounts, Roth 401ks and Roth IRAs. First of all, salaries contributed on an after-tax basis. So taxes are already paid, and then they go into the account. Attributable company match for Roth 401ks is also contributed in the traditional 401k. What that means is any match that goes in, even if you're contributing on a Roth basis, that match is considered pre-tax money. So that match doesn't go into the Roth bucket, it goes into a pre-tax bucket, if you will. The Roth will have tax-free growth and tax-free withdrawals of principal. The tax-free withdrawals of growth also occur assuming you reach the age of 59 and a half and the account has existed for 5 years or longer. A tax penalty of 10% on appreciation or gains are taken out if you take the funds out early or prior to the age of 59 and a half in most cases. Roth IRAs are also not subject to minimum required distributions. However, if you have a Roth 401k plan, then that will be subject to RMDs. You don't have to pay taxes on it, but you got to start taking that money out. So simple solution to that, if you have a Roth 401k, you're getting to the age of close to 72, roll it over to an IRA, and then you don't have to take any money out if you don't want to. Beneficiaries also inherit Roth monies tax-free. So this is the contribution limits to a Roth IRA. Now, as far as putting money into a Roth directly, there are limits on whether or not you can do that based on your income. Similar to the deductibility of the traditional IRA, this is more, though, of being able to put money into a Roth. So if you're single and your income is below 125,000, no problem, you can put money in. Anywhere between 125 and 140, you can do a partial contribution. Above 140, no contribution whatsoever. If you file jointly, bandwidth is a little bit higher. Below 198, do a full contribution. Again, between 198 and 208, partial. Above 208, no contribution. However, you can do a Roth conversion, which is basically having pre-tax money in either a traditional IRA or an employer plan like a 401k, paying those taxes up front and converting it to Roth monies. There's no income limit on doing that. There used to be, but not anymore. So this is just some of the basics of IRA conversions. Basically, a conversion is a taxable free transfer of money, or excuse me, a penalty-free taxable transfer of money from a traditional IRA to a Roth IRA. Reasons to convert, some of the reasons to consider it are basically looking to diversify your tax exposure. So you don't want to have all your money in taxable money. You want to have some tax-free growth, tax-free money down the road. You have a big expense and you got, $100,000 you want to take out and you don't want to, get clobbered with taxes because of some other income you have. Well, a Roth is a good vehicle to be able to pull money from without any taxes. Was your income too high to participate in a Roth IRA before? And now you want to do some conversions because, again, prior to, I forget what year it was exactly, but basically they used to have, if your income was too high, you couldn't do Roth conversions, but that has changed now. Do you think taxes will rise in the future? Most people say yes, so pay taxes now so that you don't have to pay higher taxes in the future. And also, do you want to maximize the wealth transfer to your children? Basically, any Roth monies that passes on to kids, they're not going to pay any additional taxes on it outside of potential estate taxes, but that's a whole nother topic. But basically, any inherited money is not going to be taxable. Any pre-tax money that comes to them, they're going to pay taxes on it. And as the Secure Act was passed, they have to take that money out over a span of 10 years. So some more on reasons to convert. A lot of this already covered, but again, if income taxes will be higher in the future, if you expect your income and spending to go up significantly faster than inflation between now and the end of the plan, if income tax rates all go up in the future, for example, Federal Reserve or the balancing the federal budget, if you'll be in R&D prison, which means that you reach the age of 72 and you have to take out more than you actually want to spend. By doing that, you're going to pay more taxes relative to your required living expenses. A Roth can help reduce that pain by paying taxes up front. If you anticipate leaving a large legacy to family individuals, kind of taking the tax burden on yourself so that your kids don't have to pay taxes when they inherit the money. Just got a question. Roth conversion can also happen anytime before or after retirement. Is that true? Yes, that is correct. You can do a Roth conversion pretty much anytime before or after retirement. A lot of times we look at it during or in the early years of retirement, since for most people, not always, but for most people, there's going to be a significant drop in income. You're kind of in this lower income threshold at that point. That's, again, assuming that tax brackets are similar or close to where they're at today. Reasons to convert more. Well, actually, this is a surplus thing. Let me skip over this, actually. But let's go into some 401k plan basics here. First of all, if you're, and we covered a lot of this already, but basically, if you're under the age of 50, and this is where you can see the amounts that have gone up over time. Used to be 2016 to 2017, you could contribute only 18,000 under the age of 50, and a total including catch-up of 24,000. Now we're up to 19,005 and a total that you can do of 26,000, and including any after-tax company match under the age of 50, you can throw in a total of 58,000. Again, that includes company match. Over the age of 50, including the $6,500 of catch-up, you can do a total of $64,500. So a lot of clients that I work with think that they're maxing out their 401k when they're putting in just $26,000. They're like, I'm putting in all the money I can. On the 19.5, I'm doing the catch-up of another 6,500. I'm maxing out my 401k at 26,000. Not the case though. You can put in an additional 38,500. Company match counts against that. When we weren't getting company match from Exxon, we could do the full 38,500 on an after-tax basis, but that is truly maxing out your 401k. So this is going to talk a little bit about in-plan Roth conversions. And we're going to start getting into the heart of the matter here, which is the Mega-Backdoor Roth. So one little caveat here, prior to doing anything on a plan conversion or an after-tax rollover, talk to an advisor, one of us, around how that can basically affect your net unrealized appreciation strategy. And that's if you have Exxon within your 401k plan or any employer stock within the 401k plan. So this is basically considering withdrawing tax paid credit balances from the savings plan and putting it into a Roth. So this is what it boils down to. The after-tax money that you have in your 401k plan, it line items here as basically $562,756.85. This is not after-tax money. This is truly your after-tax money. It's called post-86, pre-87 contributions. So what's truly the after-tax money is here. What the difference is between the two is this 562 is basically including earnings. All those earnings that this has grown to is taxable. So whenever that money is withdrawn from the plan, you're going to owe taxes on whatever the post-tax money has earned. Just got a question here. How does the mechanics of maxing out 401k work, not payroll deduction? So if I understand the question right, there's a couple different ways you can do it. On the Exxon plan, they're all 401k plans are different. So if it's not Exxon, there's other things there's other ways it can work. But basically, the way the Exxon plan works is that once you hit the limit, it spills over to after-tax contributions. So basically, you can max out your 26,000 or 19.5, whatever it ends up being, and at that point, then it spills over to after-tax. Another way to do it is simply to elect to contribute on an after-tax basis, so you spread it out more evenly over the 12 months. So you could say, I'm just going to throw numbers out there. You can contribute on a 10% basis to your pre-tax money or to your pre-tax part of the 401k, and then do another 12% after tax. Again, I'm just as an example. And then every paycheck, 10% goes in pre-tax, 12% goes in after tax, and you hit the maximums on both ends there. Also, though, you got to consider that the match is coming back. So that's going to eat away at the total you can put in on an after-tax basis, that $38,500. So that's another thing to keep in mind there. So basically, when we're looking at the tax paid withdrawals, so those earnings, if all that money had started off in a Roth IRA, all these earnings that we're looking at here, so this is the post 86, pre-87 monies here. This is truly the post-tax money. This is what it's grown to. So this is including earnings. They call it the after-tax balance, a little bit misleading, but this is what it's grown to. All of these earnings, again, are going to be taxable to you whenever that's withdrawn. And you can pull it out every year. If basically you had pulled out this money every year and dropped it into a Roth, all of these earnings would be tax-free, provided you waited 5 years from starting that account and reached the age of 59 and a half. So it's a very lucrative thing to do. Now, the way it works in terms of the rules of the Exxon plan is that basically you can pull an after-tax withdrawal twice a year. And the way it works is that you can pull a proportional amount from your 401k plan on what's truly the after-tax or post-tax money versus what the total balance is. Said another way, if you take 274,000 divided by 562,000, that's about 0.48. Multiply 0.48 by what's the true after-tax or post-tax balance here, and that is truly how much you can take out, about 0.48. And so that's what this is illustrating here. You're actually able to take out $274,049.15, but some of this earnings has to come out as well. And that's where the difference lies in terms of basically this illustration. So in this example, you're able to take out $133,455.39 and plop it right into a Roth. From there, it's going to be growing tax-free. The subsequent earnings you have to take out, that's about $140,593.76. We roll that over to a traditional IRA, keep that tax deferred, and those earnings, they're pre-tax irregardless, they're going to be in a traditional IRA and growing tax deferred over time. The benefit of this is that now this money has moved out of here and any subsequent growth it has is going to be tax-free down the road. So then there's in-plan Roth conversions, and that's basically converting some of the tax paid credit balances within the savings plan. So prior to doing this, again, consider the implications of the net unrealized appreciation. I'm more a fan of doing the Mega-Backdoor Roth as opposed to doing an in-plan conversion. Sorry, just got another question. Not sure if that's the case, but Voya had said you cannot take any after-tax money that was deposited within the last 2 years. Is there a minimum required that needs to be pulled out from an IRA at some age? So let me start with the first one. I've heard that too. However, I've not experienced that being the case. The 2-year rule, as far as our understanding is if you have after-tax money that buys the Exxon stock, then yes, that is certainly the case where you have to wait what's called a 2-year aging period before you can actually pull money from the Exxon stock and do the after-tax rollover. However, last year, and I've done this multiple times, and I just did this last year, so unless plans have changed, basically you can also do a special contribution at the end of the year, meaning you write Voya a check and mail it into them, and then do an after-tax contribution if you have some extra cash on the side and something like that. So I did this just last year, had the money go in and immediately pulled the money out and rolled it over into a Roth IRA. So the 2-year rules didn't apply in that instance. Now, unless something has changed this year or recently from when I've last done that, that's certainly not the case. I think that there is some confusion on the part of Voya on the aging of the contributions to the Exxon stock as opposed to everything else. So that is, a little bit TBD, but irregardless, try and get it out and, just see what they say. So is there a minimum required that needs to be pulled out from an IRA at some age? Yes. Once you reach the age of 72, you're required to do what's called a required minimum distribution, and that's only from pre-tax money in a traditional IRA or a 401k. The first year comes out to be about 3.6%. Every year it goes up, and it's not just a flat percentage. They calculate mortality tables and all this stuff, and basically you have to just take out what they tell you. But yeah, there is going to be an amount you have to take out for traditional IRAs. Not the case for Roths. So any Roth money you have, there's no requirements to take that out over your lifetime. All right, so as far as converting tax paid credit balances within the savings plan, first of all, a withdrawal is very different than conversions here. And this is, doing the conversions can have tax implications. The idea of doing the after-tax rollover or taking the money out and rolling it over to an IRA is that there's no tax implications. So you are simply moving money from the Voya plan to a traditional IRA and a Roth IRA. It's a trustee to trustee transfer. The way it works is that a check is actually cut, made payable to the institution you're rolling over to for your benefit. When tax forms are created the following year, they're going to have a certain IRS code that classify them as a direct rollover, so there won't be any taxes whatsoever. Not the case with doing this, which is an in-plan conversion. And sorry, I just got another question. Thanks for clarifying that this is pre-tax money that has to come out. Is there an RMD for post-tax funds in an IRA? No. So post-tax funds would go into a Roth IRA, and there would not be any required minimum distribution on that. So back to the conversion. So withdrawal is very different than this. Employees younger than the age of 59 and a half can convert a portion or all the balance in their after-tax and general accounts to basically Roth. However, funds in the before tax account cannot be converted. If you're over 59 and a half, basically you can convert everything if you want to. The basis of your ExxonMobil stock does not matter in this case. Most attribute a cost basis to shares in the pre-tax account, but for tax purposes, everything in the pre-tax account has a basis of 0. Basically, it's all income at the end of the day. It's not going to be, anything that you can report losses on and offset gains and all that. It's all income, just what the dollar amount is. When people select a higher cost basis share to sell or convert, yeah, they imagine that the IRS cares about the cost basis when in fact the only person who cares about that is the person that bought the stock. ExxonMobil stock would be liquidated in order to complete the conversion, and it's unable to be invested for a period of 5 to 7 days. And the key thing with this, though, is that you also have to do a portion. If you do convert some of that post-tax money that's in there to Roth, you also have to convert some of the earnings, some of the pre-tax money. So in this example here, and this is the most important part of this, if the entire after-tax account is, let's say, 60% after-tax or truly post-tax contributions and 40% untaxed appreciation, then basically if you convert 100% then of the after-tax account, 40% of that will be taxable income, the earnings. If you just convert 50%, then 50% will be taxable income of the 40%. If you convert 10%, then basically 10% of the 40% will be taxable income. Bottom line is, if you do an in-plan conversion, unless you don't have any earnings, you're going to owe some taxes on it. Not necessarily the ideal way to do it. Is the tax paid withdrawal technique when you're retired only? No, we do this while you're working. You can pull money from the account twice a year and roll it over to a Roth IRA. So if you have any after-tax money in there, get it out and get it into a Roth, because while it's sitting in the 401k, it's growing pre-tax, basically. Get it into a Roth and it's growing tax-free. And I'll have some illustrations of that coming up here. But yeah, this is a strategy actually to do while you're working, no matter how early on you are with Exxon or any 401k plan. So basically, when it comes to Roth conversions, a little bit more about that. Once a year, you can also convert money in an existing non-Roth savings plan account, which are fully vested, into the Roth conversion account. You got to request this conversion by December 15th. Employees younger than 59 and a half, again, can convert funds in their after-tax, stock match accounts, Roth conversion account to the Roth conversion account, However, the funds in the before tax can't be converted. Once you're over the age of 59 and a half, all of the savings plan can be converted. Wouldn't necessarily do that all at once, be a little bit more strategic and do it gradually. And retirees and terminees can also convert a portion or all of their savings plan balance to Roth. The in-plan Roth conversion will not count against the 2 withdrawals allowed per plan year for the after-tax account. Again, though, you wouldn't do both. Ideally, you're doing the after-tax rollover to avoid taxes. If you want to convert the earnings once it's in a traditional IRA, you can convert a portion of it, all of it, but you have the flexibility to do that or not and pay taxes on it if you want to. Whereas if you do an in-plan Roth conversion, you don't have a choice. You're going to owe taxes on it if there's any earnings. So this is the examples here now. So in this case, we have a base salary of $175,000. We're going to look at doing a 24% marginal tax bracket. And the 401k contributions are 12% pre-tax over the course of the year, 8% after tax, and we're doing some catch-up, $541.67 per month. So what that totals is the pre-tax is $19,005. You're putting an additional $14,000 on an after-tax basis. This is what's eligible for the Mega-Backdoor Roth. And then the catch-up is $6,500. That's also pre-tax, a total of $40,000. So this is different than doing a direct contribution to a Roth IRA if you're over the age of 50 of $7,000. Obviously you can put more by doing the Mega-Backdoor. That's why we call it Mega-Backdoor. So the way that you can contribute, also just a side note here, and the way a lot of people do what's called the regular backdoor is that if your income is above the threshold where you can get a deduction to contributing to a traditional IRA, then basically you put that money in there, you don't get a deduction, so it's not going to be taxable to you if you immediately convert it. Because you didn't get a deduction, you didn't save on taxes on it, so it's contributed on an after-tax basis. Then you can immediately convert it to a Roth. As long as you don't have any other pre-tax traditional IRA money, you can do this, get money into a Roth and not pay taxes. However, again, you're limited to $7,000 a year. Technically, with no company match, we can put $38,500. And even just in this case, $14,000 by the end of the year is still significantly more than what we can do with regular contributions in the regular backdoor method. I think got another question here. Are taxes for in-plan conversions due in the year of conversion and are withheld by Exxon? They are due in the year of conversion. They are not typically withheld by Exxon. You usually have to pay that out of pocket when you file your taxes. So they don't typically do a withholding up front. So back to this example here, you can contribute an additional, as I mentioned before, $38,500 total or $24,500 after tax, basically. Total of $38,500. $64,500 is the total, less the $40,000 that you put in there. So you could put in another $24,500 if you wanted to. So this is just kind of giving a little illustration. you make the after-tax contribution of $14,000. The 401k is kind of a pit stop. And then as soon as we can, we get it out of the 401k into the Roth and have it growing tax-free. As long as it's sitting in that 401k plan, it's growing taxable. So this 14,000, I'm going to give a really extreme example. If this 14,000 grows to $1 million while it's sitting in the 401k plan, all that growth is going to be taxable. If we do the pit stop, immediately get it to the Roth IRA, and it grows to $1 million, all that growth is tax-free, irregardless of how much it grows to. Extreme example, not likely to happen, but I use that as just an illustration of the power of having tax-free growth over time. So here's kind of a more realistic example of what this can turn into. So the total contributions, and let's say we do this year over year, $14,000 a year, getting all the way that we've by year 10 put in $140,000. Assuming a 6% growth rate over 10 years, we've grown this to $189,000. This entire amount, once you reach the age of 59 and a half, because we have satisfied the 5-year rule here, and it's 5 years from the first contribution. It doesn't reset every time you put money in, and then it's another 5 years from here and another 5 years from here. Not the way it works. It's 5 years basically from when you open the account and put your first contribution in. Any subsequent contributions don't reset that clock. It's just 5 years from the first contribution. Anyways, then now we're at basically year 10 with $189,000 at 59 and a half. That's going to be completely tax-free, all this growth plus the principal you put in there as well. Another example with just a higher base salary. This is with $350,000. We got a marginal tax bracket of 32%, 6% on a pre-tax basis, 11% on an after-tax, and then $541 again and 67 cents as a catch-up pre-tax. So the pre-tax amount we're maxing out again at 19.5. The catch-up we're doing 6,500, and we're putting in as much as we can on an after-tax basis of 38,500. This is again versus the limit of doing $7,000, much more that we can do in this method to a Roth. So you're fully maximizing the contributions of 38,500 on the back door. This is again assuming no match. Key point here: the 7% match or any match you have in the 401k plan will eat away at this dollar amount that you can put in there. So once again, 38,500 goes into the 401k. We have a pit stop there. Then we move it out into the Roth and we grow it tax-free. Get it out of there and into the Roth as soon as possible. In this example of putting 38,500, we do this year over year. We put a principal in of about 385,000, assuming a 6% growth rate. By the end of year 10, we're at $521,269 of tax-free money. As long as you're 59 and a half, you're not going to pay any taxes on this. And no matter how much it grows, it's going to be tax-free. So that's pretty much the gist of it as far as it goes. Just the thing to keep in mind is that if you have some after-tax money in there, take a look at your voided statement and you can see how much is the pre-86, or excuse me, the pre-87 post-86 money that you have in there. That's how much you have that's truly can be pulled out and go into a Roth. But keep in mind, it's going to be offset by how much earnings you have. So any earnings are basically going to count against how much you can truly pull out there. It's again a proportional amount of actual post-tax money versus earnings and the total that you can pull out of there. Irregardless, even if you have just $1,000 in there, it's $1,000 that's growing basically taxable from there. When you can get it out, move it into a Roth and have that growing tax-free. Tax-free growth is better than taxable growth. So we invite anybody that's on this seminar to have a one-on-one strategy with us. We can go over the exact mechanics, how it works, the steps you need to take to get this done. Today, we wanted to go over the bigger picture, conceptual, kind of the 50,000 foot view on it. There's a little bit of nuance in terms of how you actually get that done. Like someone had asked, in terms of that 2-year aging rule when it comes to the Exxon stock, there's some caveats you have to be aware of, but that's something we can walk through and guide anybody that's interested in looking at that. So we invite you to, come have a one-on-one financial session with us and we can talk about basically how to utilize that. So thanks for attending. Feel free to contact us. My name again is Mike Camara. This is my contact information. Feel free to reach out to me directly. You can also reach out to anybody else on our team. And we offer a complimentary and confidential retirement planning services, not only looking at the after-tax Mega-Backdoor Rollover, but also anything else that pertains to retirement financial planning. We have a lot of other seminars that will be coming up and a lot of other seminars that we've done that we have recorded. So this is recorded. This will be posted on our website. Anything you want to revisit, certainly do so. Any questions you have, let me know. And are you going to send this out? We certainly can. And also it's going to be posted on our website. So it'll be on our website as well. And I'll just sit here for a moment, see if there's any other questions. I think that's it. All right, well, thank you so much for your time. Again, feel free to reach out to me directly if you have any questions on any of this stuff, and really appreciate it. Have a great day. Oh, I think I got another one coming in. Here we go. So what is the benefit to use the tax paid credit balance to pay taxes or put in a Roth? I think that's a question around NUA. So basically, the tax paid credit balance can be applied to the cost basis of NUA. So what that means is that if you have NUA and you declare NUA, the basis on that stock is going to be immediately taxable to you. So let's say you have $20,000 as a cost basis and you have $20,000 of post-tax money. That post-tax money can be applied to the basis of NUA, and thus you don't owe any taxes when you declare NUA on any Exxon stock. So that's what is basically, I think you're asking in that regard in terms of the benefit of using the tax paid credit balance to pay taxes towards NUA. Now, if you've got years to go before you're going to retire, you're not going to do NUA until you retire. That is actually something that's not going to happen until you separate from Exxon. So I look at it as, okay, I can use, post-tax monies down the road to offset NUA if NUA is even going to make sense for me when I retire, or I can get it out now, move it into a Roth and have it grow in tax-free for 10 years. I'm going to lean more towards doing it, getting it out and moving it into a Roth and having it grow tax-free. Again, everyone's situation is different. We can look at that. If you're retiring sooner rather than later, then, different story. We want to consider everything on that front, but that's kind of where, the more time you go, the more it's, beneficial to get into the Roth and, get it growing tax-free for a longer period. Is there a similar session on IRA conversions to Roth after retirement? Yes, we do have kind of the IRA versus regular IRA versus Roth IRA that covers a lot of that. And, that's a topic that really is very prevalent for people that basically go into retirement. Roth conversions are always something we look at as whether it makes sense to do, especially if your income is going to go down significantly from the peak years right before you retire. You're kind of at the pinnacle of your earnings at that point. And there's also other instances where, there's unfortunate situations, as we all know, of people being let go from companies. If your income drops significantly, you're out of work for a period of time, silver lining with that is you can look at maybe doing some Roth conversions on any pre-tax money you have, pay some taxes while you're in this, waiting period, for lack of a better phrase, and, try and, get something out of that. But again, everyone's situation is different there. But yes, we do have some. That is, let me see. It's the traditional IRA versus Roth IRA. So that should be the name of the session there. It's thereabouts, basically. Let's see if there's any other questions here. Okay, I think that's all the questions. So I'll just hang out just another moment here, see if any other pop in. Okay, I think that's it. Well, thanks again for attending. Feel free to reach out again to myself directly or anybody here on the team if you'd like us to look at your situation specifically. Thanks again and have a great day.